Hey, good morning, everybody. My name is Jim Garner, and I'm a partner in our professional standards group, Forbes Mazars. Reside here in Dallas, and I appreciate you letting me be a part of the seminar this year. And I'm looking forward to talking about what the FASB's been up to, what new standards are recently effective or are soon to be effective. Um, I'd say for most of these, I'm going to speak about them at a slightly higher level, be talking more about why the standard was issued and what problem was really trying to be solved by it. I'll definitely talk about key points from the standard, but not really, not really get into the really nitty gritty specific details. I think for purposes of an update like this, it's most important that you all walk away, knowing which new standards are out there, which new ones are effective, and more what the changes are intending to address. That way, concepts are in your mind that will pique your curiosity, perhaps, when you encounter something that relates to this issue. Now, we'll say that some of my slides have more detailed information on them for kind of reference points later. But then if there's an ASU that is applicable to you or just you're really curious about, this way you'll have a little bit more of a base introductory knowledge to work from when you dig into it. And on that note of kind of learning more, you'll see on each slide for the ASU updates, I believe it's the first slide for each section, I have a link to Forbes Mazar's ThoughtWare article on the topic, which were written by our technical writer named Ann Coughlin. And I just want to give Ann credit for these publications because I think she has a really, really incredible ability to translate new standards into more of a plain English type manner. So pretty much anytime I'm researching something in a new standard, I go find the ThoughtWare piece that Ann wrote, read that, and then I start with that for really solid orientation. So please make note of those as we go through. And with that, I'd say let's take a look at what the FASB has been up to. On these next two slides, I'm showing the issues that I'll cover, but I have them grouped by public versus private entity effective dates. Here on this slide, you see that long duration targeted improvement ASU will be applicable for small reporting company, public entities, but the small reporting company filers. I'm sure several of you out there are familiar with this ASU, either through, association with large accelerated filer entity or because you've been getting ready for the implementation date. For others, I think this is just a great standard to be aware of. It's applicable to your entity, but you're not part of the implementation group or just, developments in the industry if it's not applicable to your entity. But, going to kind of be providing, I'd say, a wider range exposure on that one. But then, we'll talk about updates on cryptocurrencies, which I think is a really interesting and fascinating evolving topic in accounting. We've got commentary on income tax disclosures, profit interest, JVs that are being effective in a couple of weeks. And then I don't have it on the slide, but have a late edition for the FASB's new expense disaggregation disclosure. That one's applicable only for that one's applicable only for public entities, but I do want to touch on it because I think it's a pretty interesting, evolution of disclosure and transparency. Looking at the private company side, you'll see the same ASUs, but with different effective dates. By and large, typically they're pushed 1 year out with a few exceptions. And then you'll see two additional ASUs for private related to restricted equity securities and tax credits that will be becoming effective for private entities. So with that, I'm going to say let's go ahead and get started and take a look at 2018-12 on the long duration insurance contract update. Starting out, why did FASB issue this update? And I'd say that overall, the FASB received a lot of feedback from financial statement users that the existing accounting model, it really didn't provide information that was believed to be sufficiently useful, or if the information was useful, it was viewed as not really being timely. So the board made some improvements to the existing requirements for long duration contracts, which overall are intended to improve the timeliness of recognizing changes in the liability for future policy benefits. The update modifies the rate that is used to discount future cash flows. It simplifies and improves the accounting for certain market-based options or guarantees that are associated with deposit or account balance contracts. Then a fourth item, it simplifies the amortization of deferred acquisition costs. And then it's looking to improve the effectiveness of the required disclosures. So, that I want to touch on each of those five in just a little bit more detail. The ASU, it requires, excuse me, um, it requires, say, a more current measure of traditional and limited payment insurance contract liabilities. So these now are going to be updated for changes in cash flow assumptions and for discount rates. So this should help financial statement users, since the insurance contract liabilities will no longer be reported using potentially out-of-date assumptions. And let's say the use of updated assumptions provides better or more useful information. And I'd say it definitely more accurately represents the insurance entity's obligation, because it now is giving users a more current view of the expected future cash flows, as opposed to, let's say, more of a historical view. And again, one that may be slightly outdated, slightly less relevant. The issue also requires use of a liability discount rate that uses observable market inputs, and one that is independent of the insurance entity's expected return on its invested assets. So, when you think about that, I'd say this is definitely an improvement for financial statement users also, because I'd say it provides a more true representation of the time value of money for the traditional and limited payment long duration contracts, because it's now going to measure that liability for future policy benefits with a discount rate that reflects the characteristics of the liability rather than the invested assets that support the liability. The amendments on this note, they require future cash flows to be discounted using a, upper medium grade fixed income instrument yield. In other words, a much lower credit risk that is, again, maximizes observable market inputs. And, again, this would be independent of, the return that the entity is expecting to get on its investment portfolios. So I think that gets a lot more, underlying assumptions and updates to get something that's, really more correct and more useful. Kind of in the third category, the ASU requires a more consistent and current market-based measure of the capital market risk benefits that are offered in the variable annuities and other deposit or account balance products. And, I'd say specifically, financial statement users will now benefit from a consistent recognition and measurement model that's applied to contract features that have similar risks and economics. And, I think they also will benefit from a current measurement model that's going to maximize the use of observable market inputs. And I'd say also that users will benefit from just a greater understanding of the entity's exposure to the capital market risk and those benefits. And then, the extent to which the insurance entity hedges its capital market risk, because both market risk benefits and the derivatives used to economically hedge the capital market risks are now going to be measured on a consistent basis, which is fair value. That, again, is providing, better comparability. Kind of the last two aspects of the standard, it's providing, like I said, a simplified method for amortizing deferred acquisition costs, which is going to give financial statement users a clearer, more easy to understand amortization methodology. And then users are going to have a greater understanding of an insurance entity's investment and insurance risk in return that is independent from the deferred acquisition cost amortization pattern that fluctuates in relation to investment and insurance experience. And then finally on this one, the ASU provides enhanced disclosure, which includes a roll forward of beginning to ending balances of the liability for future policy benefits, policyholder account balances, market risk benefits, separate account liabilities, and deferred acquisition costs. So all of this will inform financial statement users about the individual components of changes in those balances during the reporting period, which previously they really would not have been able to ascertain by just observing the total change in the balance. And kind of on that point of, let's say, transparency, the board, through its feedback, it said that in its views, these reconciliations, roll forwards, are most likely going to be one of the most useful disclosures for financial statement users, just because of all the detail that it provides. It's really expected to provide more decision useful information and more timely information. Now, that clearly, for those of you who have had exposure to the standard, that is a high level kind of summary of what's going on. If this is something that you, again, need deeper understanding, or if this is something that you're just, curious about, want to become more knowledgeable about, then I recommend reading that ThoughtWord article that I have linked on the previous slide. There's a link, electronic link, that I believe you should be able to click on, or if you can't, or you want to look at it later, just search for that title name and a firm's name to otherwise find it. It's about a 22-page document that explains the requirements in a little bit more detail, but again, in a plain English, pretty easy to understand manner. So that's it on long duration. Clearly that's the one that is most applicable by and large to our audience. These next updates, say depending on what your entity does, what other ancillary businesses, compensation structures and whatnot, this will be applicable to groups, maybe less applicable to others. But in any event, these are some pretty interesting developments and advancements of the accounting, kind of the way the board is thinking about accounting disclosures. So that's why I wanted to make sure I covered it for the broad group as a whole. That being said, the next one is 2203, which is looking at fair value measurement of equity securities that have a restriction on them, where that restriction has a restriction on when and how the security can be sold. So looking at that one, again, I think it's important to kind of think about what are they doing, what are they trying to do, what was wrong with the previous guidance, and what's driving the need for something new. So this one is looking at, I'd say, 3 particular issues that had arisen from the exit guidance. And the first issue they're trying to solve is just clarifying the guidance that exists in Topic 820 for fair value measurements when measuring the fair value of an equity security that is subject to a contractual restriction that prohibits the sale of that security. Broad topic. The second issue is looking to amend a related illustrative example that is already in the standard. That illustrative example has been potentially misunderstood, not misunderstood, excuse me, but misinterpreted. So they are releasing an updated example to try to help drive consistency of understanding and application. And then the third matter being addressed is just clarifying the related diversity in practice interpretations that have come from the I'd say less clear, less specific guidance that's out there. So feedback was that the language in the illustrative example resulted in diversity in practice on whether the effects of a contractual restriction that prohibits the sale of the security, whether the effects of that should be considered when measuring the equity security's fair value. So some entities would apply a discount to the price of the equity security that was subject to the restriction, whereas other stakeholders consider the application of the discount to be inappropriate under the principles of Topic 820. So you can imagine that would yield 2 potentially significantly different answers for the same fundamental facts and circumstances and economic characteristics. So to address that, this update introduces new disclosure requirements for these securities that are otherwise subject to Topic 820. And I'd say it's worth pointing out that the amendments in this update, they don't change the principles of fair value measurement. I want to make sure that part's clear. But rather, it's clarifying those principles when measuring the fair value of equity securities with such restrictions. And then the update also, I'd say, improves current GAAP by reducing diversity in practice, which again should help drive comparability of valuations of the same underlying economic characteristics. The update, looking at kind of the scope, it clearly will impact all entities that have investments in equity securities that do have restrictions on their contractual sale. And then you can see a few of the more common examples here on the slide, things like underwriter lockup agreements, market standoff agreements, certain restricted provisions that just may be included in a contract in general, and then a couple of things related to SPAC-related investments. I think I mentioned disclosure, and on that, the update clarifies that a contractual restriction on the sale of an equity security is not considered part of the unit of account of the security, and therefore it's not considered in measuring the fair value. And personally, I think that is an interesting distinction, an interesting clarification, because just personally, I think the alternative view had a lot of merit, and it was understanding how parties are coming up with different answers. But the board, through their discussions and evaluations, concluded that, again, that the restriction is not to be considered part of the unit of account, and therefore would not be considered in measuring the fair value. The amendments, they also clarify that an entity can't, as a separate unit of account, recognize and measure the contractual sale restriction. So again, you have the fair value of the security, you do have a restriction, but there's no bifurcation of that. You don't have that as a separate unit that you deal with. And then the update, it requires that the equity securities with these restrictions disclose three things: the fair value of the equity securities that are subject to the contractual sale restriction, the nature and the remaining duration of those restrictions, and then circumstances that could cause a lapse in the restrictions. Overall, I think that is going to give, again, more decision useful information, more comparability, and should be much more helpful to analyst evaluations and users in general. Effective dates of this one, transition approach, as you saw in the first slide, but just to restate it here, for public business entities, this is effective for fiscal years that begin after December 15th, 23. So, typically 2024 calendar years. For other entities, it's 1 year later, for years beginning after 12/15/24. So for a calendar year entity, that would be calendar year 25. Entities can early adopt this, and it applies for all entities except investment companies as defined by 946. And again, you should see the thought word article that I had there if you want to dig into this one a little bit more. And on here, I'll take a little acknowledgement of a attendance check, CPE verification. Okay. So then next on the list, we've got ASU 2023-02. This one's looking at tax credit structures. Investments that are intended to obtain benefit in some manner related to an income tax benefit. So, and I'd say specifically, it's looking at how this is amortized. With this one, FASB is trying to drive consistency for how entities account for equity investments that were made primarily to receive income tax credits and other tax benefits. ASU 2014-01, which relates to equity method investments and joint ventures, that introduced the option to apply the proportional amortization method to account for investments that were made primarily to receive a tax benefit. But the amendments in that update, they were limited. They limited the proportional amortization method only to investments in low-income housing tax credit structures. So even though there are other structures aiming to achieve similar tax benefits, the proportional amortization method was only allowed for LIHTC structures. So that particular method, it results in the cost of the investment being amortized in proportion to the income tax credits and other income tax benefits that are received, when the amortization of the investment and the tax credits being presented in a net manner on the income statement as a component of income tax expense or benefit. But equity investments in other tax structures, they're typically accounted for using the equity method, or under topic 323, which is for investments in equity securities. And that guidance results in investment income, gains, losses, and tax credits being presented gross on the income statement in their respective line items. So you think that can drive pretty substantially different conclusions and presentations for things that may fundamentally be trying to accomplish the same objective. And on that note, FASB received feedback that tax equity investors in economically similar investments that are made primarily for the purpose of receiving an income tax benefit of some sort, they should all have the same election as the LIHTC investors to account for those investments using the proportional amortization method. And then also, in view of those providing feedback, the proportional amortization method, it provides financial statement users really with a better understanding of the returns from such investments versus the accounting answer under the equity method or under topic 321. So because of the extant limitation on the application of the proportional amortization method to account only for eligible LIHTC investments. Stakeholders asked the board to allow reporting entities to elect to apply proportional amortization method to account for tax equity investments of a broad variety that are aimed at generating tax credits or other benefits through tax programs. And then one other comment on the LIHTC investments, if that's something that your entities have been engaged in. Topic 323 currently applies to all LIHTC investments, regardless of whether they are accounted for using the proportional amortization method or not. So kind of on that note, stakeholders question whether the specialized guidance for LIHTC investments that are not accounted for using the proportional amortization method should be retained in the subtopic. And then in response, the amendments in this update actually remove the specialized guidance for LIHTC investments that are not accounted for under the proportional amortization method. And looking at, say, some criteria on the qualification side, you see 5 bullets here. These are the things that have to be met in order to qualify for the proportional amortization method. You see here, looking at the probability of the credits being available, the investor not having the ability to exercise significant influence over the operation of the entity, substantially all of the projected benefits coming from income tax credits or other tax benefits, and the investor having a projected yield that is positive. And there in the last bullet, you can see some commentary about legal structure requirements. Now, for the disclosures, I'm sure everybody's also kind of seen over the past couple of years, really a trend for more disclosures, more detail, more transparency, which I think is overall a good thing for the investing public and the financial statement users. So for this ASU, on a disclosure note, the amendments require that a reporting entity disclose information to help investors understand information about its investments that are generated, that are designed to generate tax credits and benefits. And there are 2 items that need to be addressed. First is the nature of the tax equity investments. And then the second is the effect of its tax equity investments and related tax credits on its financial statement position and results of operation. So you can see some additional details that have to be addressed here on the slide. And then again, if you want to learn more, you can look in the ASU and find some example disclosures that an entity could provide to help meet these objectives. From an effective date, again, this one's effective for public business entities for fiscal years beginning after 12/15/23, and then for all other entities 1 year later, years beginning after 12/15/24. On a transition comment, this one can be applied either modified prospectively or retrospectively. And for the retrospective transition, you would evaluate all investments that are still expected to generate some sort of benefit as of the adoption date. Then obviously for retrospective transition, you would go back and look at anything that existed going back to the beginning of the earliest accounting period being presented. Yeah, next update we want to look at relates to joint ventures. And this one for joint ventures, this ASU, it addresses very specifically just looking at the beginning of a JV formation. It addresses the accounting for contributions made to a JV upon its formation that are in the JV's separate financial statements. So here what FASB is trying to accomplish is, again, provide better, more useful information to financial statement users, then also help with some comparability issues that I'll talk about that have resulted in diversity in practice interpretations. Now, I'm not sure any people know this to the extent you deal with JVs, but GAAP, it actually doesn't provide specific authoritative guidance on how a joint venture upon its formation should recognize and initially measure assets that are contributed and liabilities assumed. So in the absence of specific GAAP, people are typically left to try to interpret or to analogize. And then GAAP even states that transactions between a corporate JV and its owners are actually outside the scope of Topic 845, which is non-monetary transactions. And also the formation of a JV is outside the scope of Topic 805, business combinations. So again, that kind of left open a lot to be discerned, figure out, interpreted, and whatnot. So, people would look at other disclosures. They would look at speeches by FASB, SEC, and it just understandably created a lot of diversity in how this was all interpreted and applied. Some entities, they would basically account for the formation almost like a business combination, remeasuring things at fair value. And in other cases, the entities would decide that no, we're going to take a carry forward basis and measure things at their original carrying amounts. So to kind of address this and reduce the diversity that has resulted, the board has decided with this ASU to require that a JV apply a new basis of accounting upon its formation. So that means that the JV is going to recognize and initially measure its assets and liabilities at fair value, with a couple of exceptions. But some things that don't change, the amendments in this update, they don't amend the definition of a joint venture. The accounting by an equity method investor for its investment in a JV does not change, nor does the accounting for a JV and contributions received after the formation. So again, this is just looking very specifically at the formation date. Again, this one, the one thing I would take a look at when applying this is just the definition of what a joint venture is. And for that, you look at the definition of a JV as defined in the master glossary of the codification. And then, I want to point out here that the existing joint ventures, they actually have the option to apply the guidance retrospectively. And then here on the slide, I just included a few situations where the ASU would specifically not apply. Just give a couple of seconds to scan through that list if you would like. Okay, so a couple of points to highlight is that, requiring a JV to recognize and initially measure all of this using a new basis of accounting. I'm sure you can see this is really generally much more consistent with other new basis accounting models, such as fresh start accounting, and, in a sense, business combination accounting. But there are a couple of key adaptations from business combination guidance that the JV would apply. And that is that a joint venture is the formation of a new entity without an accounting acquirer. So the formation of the JV is, again, the creation of a new entity, and none of the assets or businesses are viewed as having survived the combination as an independent entity. And then the JV, it measures its net assets and goodwill at the formation date. And that formation date, obviously another key data point for determination, that is the date on which an entity initially meets the definition of being a joint venture. Again, with that definition being defined in the master glossary of the codification. I want to move over to the disclosures real quick. Just a couple of quick comments on measurement to continue if you want to read those. But moving on to disclosures, you're really looking at just, again, providing what do people need to know about how it came together, how it was measured, what's being contributed, and things of that nature. So this one is effective prospectively for all joint ventures with the formation date on or after January 1st, 25. And then, like I said, it can also be applied retrospectively if there is sufficient information to do so. So that let me turn my attention to something that I mentioned in the beginning, and I think it's kind of an interesting evolving area, and that is related to crypto assets. This is obviously cryptocurrency gets a lot of attention in the media. It is an area that I'd say a lot of maybe risk-adverse companies have been reluctant to get into recently, but I think we are definitely seeing over the last year or months a much more consistent and steady entrance into holding crypto assets. So with that, the board is trying to advance the accounting cause a little bit more, looking again at trying to provide better guidance on accounting and then more consistent and relevant disclosure. So, this FASB had heard from a lot of different stakeholders that approving the accounting for and disclosure of crypto assets really needs to be a top priority of the board. So this issue is coming out, and I expect we will continue to see more clarification and interpretation on this in the coming months and year. So the stakeholders stated that current accounting, except for a couple of really specific exceptions in very specialized industries, but current accounting for holding of crypto assets, it requires them to be held as indefinite-lived intangible assets, which would be a cost-plus impairment accounting model. And that really doesn't provide financial statement users with information that is particularly useful. Specifically, say, accounting only for the decreases, but not the increases in the value of the crypto assets. You're not accounting for that increase until it's sold. It doesn't provide relevant information that reflects the underlying economics of those assets or the entity's actual financial position. So investors requested that additional disclosures be made about the type of crypto assets being held and then the changes in those holdings. So in addition to better reflecting the economic, the underlying economics of the crypto assets, measuring those assets at fair value will also, I would say, likely reduce cost and complexity associated with applying the current cost-plus impairment accounting model. So the main provisions on this one, an entity will be required to subsequently measure assets that meet those criteria, criteria being a crypto asset, required to measure those at fair value where the change is recognized in net income each reporting period. So just much more consistent with fair value type accounting. And the amendments in the subdate, they also require that an entity present crypto assets measured at fair value separately from other intangible assets on the balance sheet. And changes from the remeasurement of those crypto assets has to be presented separately from changes in the carrying amounts of other intangibles as well on the income statement. So again, recognizing these are different, they typically have different risks, economics, and providing more transparency into what the entity's structure and operations actually are. I'd say while the amendments in this update don't otherwise change the presentation requirements for the statement of cash flows, the amendments, they require specific presentation of cash receipts that come from crypto assets that are received as non-cash consideration. Let me say it again, that it requires them to be presented as non-cash consideration in the ordinary course of business and that are converted nearly immediately into cash. Scope of this one, I mentioned that it relates to assets meeting certain criteria. You see those here on this slide. It has to meet the definition of an intangible asset as defined in the codification. It cannot provide the asset holder with enforceable rights or claims on underlying goods or services. The asset has to be created and reside on a distributed ledger, blockchain, something similar. Must be secured through cryptography, must be fungible, and then is not created or issued by the reporting entity or related party. For disclosures on this one, the amendments require that the entity, including entities that already have industry-specific guidance, disclose the following information: the name, cost basis, fair value, and number of units for each significant crypto asset that they're holding, and the aggregate fair values and cost basis of the crypto asset holdings that are not individually significant. And then for crypto assets that are subject to contractual sale restrictions, we see that theme coming back through this issue as well, that for that one, it has to disclose the fair value of those crypto assets, again, same disclosures as we heard in the other issue, the nature and remaining duration of the restrictions, and circumstances that can cause that restriction to lapse. For annual reporting periods, entities also have to disclose a roll forward in aggregate of the activity in the reporting period for crypto asset holdings, including additions, disposition, gains, and losses. For dispositions of crypto assets in the reporting period, it needs to show the difference between the disposal price and the cost basis, and a description of the activities that resulted in the disposition. And then if gains and losses are not already presented separately, need to disclose the income statement line item in which those gains and losses are recognized. And then last, the method for determining the cost basis of the crypto. I have a couple more here to look at. Income tax disclosures. think I want to come on this one just a little bit higher level and summary focused on this one. This one is focused on trying to enhance transparency of tax disclosures. Branch statement users, they've provided feedback that the existing income tax disclosures need to be enhanced to allow them to better assess how an entity's operations and related tax risk, tax planning, and operational opportunities affect its tax rate and prospects for future cash flows. Currently we have the rate reconciliation table and other disclosures, including taxes paid, which help evaluate income tax risks. But while the investors find that information helpful, they have said that other enhancements would be helpful to help them better understand the entity's exposure to potential changes in jurisdictional tax legislation, to assess income tax information that affects cash flow forecasts, capital allocation decisions, and information that helps identify potential opportunities to increase future cash flows. So with this update, FASB is trying to address those specific points and provide disclosures to provide that information. On these next couple of slides, there are, let's say, essentially 8 categories that need to be addressed in the disclosure. Rather than, let's say, read or talk through each one of these, I just want to leave these 2 slides here with you as a resource when you're looking at it, later for your entity or just for your curiosity. But you see state and local tax, foreign tax, enactment of changes in tax laws, cross-border impacts. And then on the next slide, things related to tax credits, non-taxable or deductible items, valuation allowances, and changes in the unrecognized tax balance. This one does have a little bit of an easier implementation for non-public business entities, in the sense that non-PBEs could address these categories in a qualitative manner, whereas versus a tabular format. But need to make sure that each relevant category has been appropriately addressed, described, and has sufficient detail. The nature of that disclosure, it really can be quite long, or it can be quite short. This is an example of, excuse me, one pass. This is an example of what a qualitative example could be for a very simple structure and situations. You see that one is just a couple of lines. Also, I think depending on what's going on, this could be, quarter page. But just thinking through what's relevant and what's useful and helpful. I want to move on to profit interest next. I'll advance through a couple of slides that I wanted to leave here as resources. So for profit interest, second to last one on the cover, and then the expense disaggregation. This one, it covers updates related to profit interest. And it said the FASB, it's aiming to improve the existing GAAP, really just by adding a illustrative example to demonstrate how an entity should apply the scope guidance in topic 718. Basically, when looking at whether an arrangement is a profit interest or a capital interest, there's no bright line definitive determinate information. There are factors that indicate one and factors that indicate the other. But with that, anytime there's judgment, you can obviously get to a different answer that is reasonably determined. But it has resulted in different answers for essentially the same thing. So, looking at profit interests here, current guidance, because profit interest holders only participate in future profits or equity appreciation, and they really have no rights to existing net assets of the entity. Stakeholders indicated that it can be, really difficult to determine whether that should be accounted for as a share-based payment, which would be topic 718, or similar to a cash bonus profit sharing agreement, which would be under 710, just general compensation. So to help address this, the amendments in the ASU, the illustrative example, it includes 4 fact patterns to demonstrate how the entity should apply the scope. There obviously can be situations outside these four, but these really were designed to either encompass the vast majority of arrangements that are out there, or at least provide enough insight to make it a shorter leap of judgment to bridge the gap to the situation the entity is looking at. And then the last item look at is the expense disaggregation. I think this slide got out of order. We're going to look at 2401, which is expense disaggregation. For here, it's, if you think about the P&L, there are a lot of expense categories that are disclosed specifically. They provide transparency, they provide visibility. But then typically we get to SG&A, and that is a large number. And an entity may have SG&A broken out, it may not. But with this one, the FASB is saying, hey, look, there really is a lot of, let me go back to the slide that was out of order for this, excuse me. There are other things that really drive decision making. So with this issue, it requires additional disclosure of anything in that SG&A category that relates to purchase of inventory, employee comp, other allocated depreciation, intangibles, some items that are specific to oil and gas activities. And this one, again, I just kind of want to keep this high level because this one, the effective date is pushed out a little bit more. But it's going to require a table to be included that reconciles to the balance on the face of the P&L, and then breaks out each of the individual categories. And it was at the ASEPA's PCOB conference earlier this week, and the FASB was talking about this particular standard, and they had a really good disclosure example up there that just kind of maps out where everything goes and where it resides. There are certain expenses that already require disclosures through their standards, but for those get brought into this to really just provide a centralized kind of all-encompassing area for investors to look at. Kind of glossed over that one, mainly due to time, also because it's only applicable to public business entities, and the effective date, like I said, is pushed out a little bit further into the future on that one. But the last thing I want to cover here is related to research projects. Let's see, we have really seen the past year with all the regulators, more of a ramp up in the activity that they're trying to address. The quote that the pace of change will never be slower than it is today. That's something that I think we have all just really had driven home to us over the past few years. And regulatory models need to move at a certain pace, to be thoughtful, to be methodical, to make sure they minimize unintended consequences. But when change is going as fast as it is, sometimes the regulations need to jump forward to continue to be helpful, useful, and relevant. So, that's a big reason I'd say why we've been seeing so much more activity from the regulators. So here on this last section, it's just a couple of slides, but to wrap up, I just want to look at what the FASB's research agenda is. There are about 6 items that they're looking at in order to see if or how certain issues can be addressed through new revised guidance. These are things that certainly won't become effective standards for quite some time, if at all. The research process and the exposure and the proposal and the revision, as y'all know, it can take several months. It can take a couple of years. But I just thought you might be interested to see where they're placing their attention and kind of where they see the world of accounting regulation moving. So the first 4 here, we can see relate to the accounting and disclosure of intangibles, which is going to explore ways to improve transparency of what's driving intangibles, kind of components and information within that. Like I've said a few times, disclosure is really become a focal point for regulators, and financial statement users, making sure that the disclosures are really kind of telling a story of what has been occurring and the what's and the whys of that. They are looking at accounting for commodities. Again, mainly looking at disclosure issues for what is driving the commodity activity. What are the economics behind it, the amounts incurred and whatnot. And then they're looking at consolidation for business entities, and that's going to be an interesting one, I think, because it's really looking to see, is it possible to just have one single consolidation model that could be developed for business entities? Point that FASB made on a couple of different sessions during that conference was trying to hit the balance and also trying to understand from stakeholders, what is it that the users of financial statements really want? Do they want a more simplified manner to get to the same answer? Or do they think that the guidance needs to be altered in a manner to drive a different answer? And they acknowledge that those are obviously two fundamentally different approaches. So they want to understand really what the ask is, but then also to be a little bit more intentional on how they go about making those improvements. The ability to have a single consolidation model would obviously be helpful for implementation. I think it could drive, efficiencies, reduce costs. But obviously, when you reduce choice, you may inadvertently impact the analysis and the results that come from that. And then the last item on this slide is to refine the definition of a derivative. Again, this is one where they talked about what is the outcome that's trying to be driven. We've seen changes to derivative accounting, trying to either make things more specific, trying to allow more things to be brought in scope, like with the portfolio layer method coming into play rather than just the last layer method. But here again, trying to look at what items need to be considered as derivatives and which other ones, are either addressed by other accounting or could be addressed by other accounting, but perhaps in a more simplified manner. Last two scope items that they're looking at, research items they're looking at, is key performance indicators for the business entity, which is going to kind of look at, are there standard or certain financial KPIs that are relevant for evaluating the health and performance of the entity. And I think this one's interesting because on the audit firm regulation side, on the PCOB, Public Accounting Oversight Board, they are also exploring standards related to KPIs of audit firms. So I think from just a regulation standpoint at an overall level, realizing that there are KPIs that are viewed internally, and those might be helpful for other people who are interested. There might be other KPIs that need to be mandated because they would provide a more comparative view. But I personally am kind of interested in where that goes. On one side, I think it provides a lot of interesting information. On another side, it's possible that it could be asking for a little bit too much information. But I think conceptually, it's one that I think is kind of interesting and intriguing. And then the last one, they have a project going on with statement of cash flows. Statement of cash flows is an area that I also really like a lot because it's very complicated. It can be a very complicated statement to prepare or to analyze. I think as a result, there can be a little bit higher possibility for error due to people's understanding, be it detailed or lack of. And then also because, anytime an entity has a non-recurring transaction, something unique, something that they don't really have an established process for, that introduces risk because it's new. There may not be sufficient knowledge or expertise to evaluate it. So a lot of times there are transactions that an entity enters into that have specific rules for how they need to be treated on the cash flow. And then you also think about investors. Two of the most important things they look at is pre-tax income, generally, definitely exceptions to that, particularly for statutory accounting and regulators looking at solvency. But just seeing how they can make this a more useful statement. And Matt, I thought we were going until 11:10, but you coming on camera makes me think we're going until 11 Central Time.
No, you can keep going if you have more to go, but
No,
I know you're getting close, so I was just getting in the queue.
Pardon me?
I said I was just getting in the queue, so I'm ready to go.
No. That actually was the last thing I wanted to talk about. Just that, I think we really see the advancement of the regulators trying to get current and stay current and get a focus on transparency for the users. But yeah, Matt, please.
Got it. Well, Jim, appreciate that. So when Denny was talking about some of the uses for AI and using it for his wife, I was like, well, I wonder if I could get it to write a closing for me that would be way more sincere and thoughtful than what I could come up with. And so I took 3 attempts. First, I said, write me a 60-second closing for a virtual seminar, insurance seminar attended by clients and prospects. And it was really good, but it focused more on insurance, not insurance accounting. And so it was like talking about the importance of insurance and protection and security and all of the things that we think about. And I said, so I changed it to write me a 60-second closing for a virtual insurance accounting seminar attended by clients and prospects. So I added insurance accounting. It was great. Then I was like, we are in the holiday season, so we should probably add something there too. So my final ask was write me a 60-second closing for a virtual insurance accounting seminar attended by clients and prospects during the holiday season. And I'm just going to read it to you because I couldn't do it any better. Thank you for joining us today during this busy holiday season. We truly appreciate you taking the time to learn more about insurance accounting and how it can support your financial goals. Our goal is to make these complex topics simpler so you can make informed decisions with confidence as you plan for the future. As we reflect on the past year and look ahead, remember that our team at, in parentheses, your company name, is here to support you. That would be Forvis Mazars, is here to support you every step of the way. Whether you need help navigating compliance, streamlining processes, or addressing specific challenges, we're just a call or email away. Wishing you and your loved ones a joyful holiday season and a prosperous new year. Thank you again for joining us, and we look forward to partnering with you in the upcoming year. Stay safe and happy holidays. I mean, that's absolutely perfect. So if we're not using ChatGPT, I don't know that I won't just use this for every interaction I have for the rest of my life. We're missing a great opportunity. So anyway, appreciate everybody joining today and yesterday. Again, we'll leave it with what ChatGPT said. Happy holidays.